Hi, I'm Doug Carroll. Welcome to Fixed Income Securities Bond Contract Basics. This module is intended to give participants an introduction to the features common to the vast majority of fixed income securities, as well as an introduction to the basics of risk and return. Before we get into the details, a brief overview of what to expect during the course of this module. The bulk of the program will focus on the fundamental characteristics and features that are common to the vast majority of fixed income securities. The last portion of the session will give a brief introduction to the fundamental concepts regarding risk and return related to investment and debt instruments. The first section on bond fundamentals will have a heavy emphasis on contract features such as par and maturity and coupon. Naturally, an integral part of becoming familiar with fixed income contract features is becoming conversant with the related concepts and terminology. The last portion of the session deals with the investment characteristics of fixed income securities. It will introduce participants to the primary sources of return as well as the major types of risk holders of fixed income securities need to consider, connecting both the sources of return and types of risk with the pertinent contract features. So let's begin the discussion of those contract features common to the vast majority of debt instruments and the related terminology. The issues we'll focus on in this portion of the module are contract features encountered with the vast majority of fixed income securities, like par value, issuer, coupon, and maturity, as well as the conventions for expressing the value of the contract, the price. To provide a framework for discussing these issues in context, let's use a hypothetical bond quote that would incorporate all of that information. The information will be presented in a fashion consistent with the way market participants might convey the details related to bond investments or values. Consider the hypothetical bond quote at the bottom of the page. At a first pass, I'll talk through the contract elements without any explanation. But don't worry about capturing all the details at the first pass. I want you to hear the information initially as it might be presented by one market professional speaking to another. However, over the subsequent pages, we'll review each of the elements related to this bond in great detail, explaining each aspect of the contract using plain English to address the concepts while introducing related industry jargon. What a market professional would infer from the information at the bottom of the page. We have $100,000 par value of bonds issued by the XYZ Corporation, carrying a 4 3/4% coupon rate, maturing sometime in the year 2024, priced at 95% of its par value. Here you see reprised the bond information from the previous page. So let's consider that hypothetical bond quote at a slower pace and provide a bit more detail before we begin to interpret and explain those numbers and symbols. First off, we have an indication as to the par value, 100M or 100,000. Next is a three-letter symbol representing the issuer of the security. Here we see XYZ. Assume that is the ticker symbol for some corporate issuer. The 4 3/4 apostrophe S expresses the bond's coupon rate of 4 3/4%, followed by apostrophe 24, which specifies the year in which the bond matures, 2024. Clearly, there is no indication as to the specific maturity date, simply the year of maturity. And lastly, there is a representation of the price expressed as a percent of the bond's par value. Let's begin our inspection of fixed income contracts by discussing the methods used to express the size of the bondholder's claim. For the vast majority of fixed income securities, the following terms have precisely the same meaning: par or par value, face amount, face value, principal or principal amount. All of these words or phrases are generally interchangeable with one another, at least for term bonds, securities where all of the principal is due at maturity. The implied meaning: the amount the issuer is obligated to pay, in addition to any coupon interest payments, to pay off the obligation or extinguish the liability. As always, there are exceptions. For instance, with amortizing securities, it's necessary to distinguish between the original face amount and the current outstanding principal. The original face amount being just that, the face amount of the security at the time of issuance. But if it's an amortizing security, that is, the principal is being returned over time, we'll also want to keep track of the still outstanding principal or the current outstanding principal. The latter amount is important for several reasons. From the perspective of the investor, the still outstanding principal represents both the amount of principal to be received in the future, as well as the amount of principal upon which the contractual rate of interest is being paid. Naturally, on principal that's already been returned, no further interest is due. Consider some of the terms just discussed to indicate the size of a fixed income contract. Face value or face amount, which is occasionally shortened to simply face. Where does that terminology come from? Well, it reflects the historical evolution of bond markets. At present, a significant portion of existing fixed income securities have no physical embodiment. They exist in book entry form only. That is to say, there is a record of ownership kept somewhere in the books wherein the issuer or its agent holds information regarding ownership of the issuer's securities. Today, of course, those would likely be mostly kept electronically or in digital form. Until just a few decades ago, most bonds did take physical form. Bond buyers' ownership would be evidenced by a paper certificate. You see an example of a bond certificate before you. It's a bond that was issued by the City of Boston. The bond was issued in the UK as London was the preeminent capital market in the world at the time of issuance, so the bond was denominated in pounds, also called sterling, short for pound sterling, referring to a Norman coin from which the currency's name is derived. This bond has a par value of £100, paying a 5% annual interest rate in the form of 2 semi-annual coupons for £2 and 10 shillings each, 10 shillings equaling 1/2 of a pound. Far enough back in time, settling a bond trade would require the seller to deliver the physical certificate with all of the unpaid coupons attached for the delivery to be in acceptable form. Good delivery in industry jargon. Given the high cost of printing, transporting, and safekeeping of the paper certificates, the cost benefits of the book entry form of bond trading are clear-cut. So face value or face amount became one way of expressing the par value, as the amount of the par value is printed on the face of the certificate. Let's explore par value in more detail here. The 100M in our hypothetical quote indicates $100,000 as the principal or par value of the bond. At least that would be the interpretation in the US, where M will be taken as the abbreviation for 1,000 in most contexts. A cautionary note here. In some markets, such as the UK, M would be taken as the abbreviation for 1 million. Generally, it's extremely important when reading information from other markets or interacting with colleagues or clients that usually operate in different markets, that one is extremely careful with the interpretation of communications. The same word or symbol will oftentimes have at least a slightly different, and in some cases a radically different meaning or interpretation. Some related industry jargon. In the parlance of the business, sometimes the word bond is used as synonymous with $1,000 par value. Consequently, a $100,000 par value bond might be referred to as 100 bonds. Or in some instances, information, such as price or conversion ratios, might be provided on a per bond basis, that is, per $1,000 par value. The par value or principal is what the bond issuer is obligated to pay in addition to any coupon interest to extinguish the liability. But a bond's principal is often not equal to the amount borrowed, as would typically be the meaning of principal for a loan. That's because bonds are often issued at prices other than par. It's a circumstance that's a result of a coupon setting convention followed in certain market sectors. Many issuers follow conventions wherein interest rates or coupon rates can only be set at specified increments. In the U.S. agency mortgage-backed securities market, for example, coupon rates are set only at 0.5% increments. In other words, 4%, 4.5%, 5%, 5.5%, etc. Other issuers, including U.S. Treasury, follow the convention that coupons will be set at 1/8% increments. For example, 4, 4.125%, 4.25%, 4 3/8%, etc. Market rates of interest will frequently fall between the convention-based coupon rates. The result for issuers that follow such conventions is to offer bonds at a price different from par. The specifics of that relationship will be discussed in detail in a module on bond math, although we will address the concept later in this module. Another important implication of par value regards the par amount of the bond you're trading. The par size might have some impact on price and ease of sale, in other words, liquidity. In general, bonds are more easily sold or bought and at better prices when trading in round lots. What constitutes a round lot is a situationally specific amount. In general, the phrase round lot means the normally acceptable trading unit. Most people are probably more familiar with stock trading. For U.S. traded stocks, 100 shares is considered a round lot. In the bond market, there is no standard definition of round lot across all market segments. It's whatever is the normal trading unit in that particular market segment. So for instance, when trading corporate or municipal bonds on the institutional side of the business, it might be that 100 bonds would be considered the normal trading unit. In other words, $100,000 par value would be a round lot. In the U.S. Treasury securities market, interdealer quotes are typically good for a minimum of $10 million par value. The Treasury market being much larger, the normal size trading unit is larger as well. The next symbol in our hypothetical bond quote, XYZ, identifies the issuer of the security, the infamous XYZ Corporation in this instance. The issuer of the security is borrowing via the bond offering. Normally, it's the borrower's responsibility to pay the principal and interest as the monies come due. Usually, it's the issuer's financial condition that will be the primary determinant of the credit rating of the issue. Most of the time, an issuer's creditworthiness is related to its ability to generate revenues. Operating revenues for corporations, or tax revenues for governments, by way of example. However, other factors might come into play. The issuer might have valuable assets it could pledge as collateral. The issuer's access to additional funding, access to credit lines, or lack thereof might be a consideration. Access to additional credit and ability to repay future borrowings will be impacted by the amount of debt already outstanding. Large amounts of debt outstanding already would cause any additional issues to be viewed somewhat more skeptically, whereas an issuer that has little or no debt outstanding, other things equal, would be viewed as more creditworthy. Beyond all of the factors previously cited, a debt issue's credit rating can be improved if one or more types of credit enhancement, such as a guarantee or bond insurance, is present. Such factors will cause the issue's credit rating to be mostly a function of the creditworthiness of the provider of the credit enhancement rather than the financial condition of the debt's issuer. One other sometimes overlooked consideration. Investors' familiarity with the issuer can potentially impact the marketability of the securities. A widely known issuer's debt will often trade at lower interest rates than comparably rated debt from lesser known issuers. Next, we'll consider bond coupons. In our hypothetical XYZ bond example, 4 3/4% is the coupon rate. The coupon expresses the interest owed to the bondholder as a percent of the par value. Coupons are typically payable periodically over the life of the bond. Some people new to the bond market wonder why there's an apostrophe S after the coupon rate. It's just a market convention for expressing coupons. That fashion for expressing coupons is likely connected with the shorthand way of identifying bonds. Oftentimes, bonds will be identified by a subset of the contract's characteristics. In this case, the bond we're considering, a shorthand description might be the XYZ 4 3/4 of 24. In other words, simply by identifying the issuer, coupon rate, and year of maturity, we can usually distinguish that one security as distinct from all the other millions of issues trading in the fixed income market. The coupon payments would be determined by multiplying the coupon rate by the par value. In our example, we have a $100,000 par value bond with a 4 3/4% coupon rate, which is 0.0475 in decimal terms. Multiplying the coupon rate expressed as a decimal equivalent times the par value will give you the dollar amount of the annual coupon payments. In our case, that would be $4,750. The actual coupon payments would likely be for different amounts unless the security compounds annually, that is, pays interest once a year. Annual compounding is not very common in the United States. However, it is the norm on the continent of Europe. If this were a bond issued on the continent of Europe, one might expect a single coupon payment of €4,750 once per year. In the US, semi-annual compounding, twice-a-year coupon payments, is more typical, though quarterly and monthly pay instruments are also common. The periodic coupon would be determined by taking the annual amount, which results from the par times the coupon rate, and dividing by the number of coupon payments per year. So if the coupons were payable semi-annually, you'd take the $4,750 annual coupon payments and divide by 2 to determine the amount of the periodic coupon of $2,375. And of course, if the coupons were payable quarterly, the quarterly coupon payment would be $1,187.50. There is another significant coupon-related matter that needs to be addressed. It's a bond's coupon rate versus the yield to maturity the market requires for bonds of the same maturity and creditworthiness that usually is the primary determinant of a bond's market price. I'll use that phrase, market rate of interest, as a shorthand way of expressing that rate, that yield to maturity. For most bond issues, the coupon rate is set at approximately the market rate of interest at issuance. Consequently, most bonds will be issued at a price close to par. Once a bond has been issued, its price will have to adjust to reflect any difference between the coupon rate on that bond versus the rate the market currently requires for bonds of similar maturity and credit risk. For most bonds, the contractual cash flows are fixed, yet market rates change. If a current holder wishes to sell a bond, it must be offered at a price so that the yield to maturity is comparable with bonds of equivalent risk regarding maturity and creditworthiness. Since the selling bondholder can't alter the contractual cash flows, the price at which a bond is offered will be adjusted. A bond's price will move inversely relative to changes in interest rates. In general, a bond's price moves so that the implied capital gain or loss to maturity, along with the periodic coupons, implies an expected rate of return competitive with equivalent risk bonds. Bonds with coupons equal to the current market rate of interest will trade at par. Bonds with above market coupons will trade at a premium to par, that is a price greater than 100. Bonds with below market coupons will trade at prices below par or prices less than 100. Let's consider more closely how market rate changes influence bond prices. What's the connection between a bond's coupon and its price? A bond's market price will adjust to offset differences between its coupon rate and the market rate of interest. Recall how I'm defining the phrase market rate of interest as a shorthand way of saying the yield to maturity the market seems to require for bonds of a given time to maturity and credit risk. Let's consider the impact of rising interest rates on a bond's market price. Assume we have a bond A issued in 2013 to mature 15 years later in 2028, having a single A plus credit rating and a 5% coupon rate. Let's also assume the market rate of interest at the time of issuance was 5%, so bond A was initially sold at par. What if interest rates generally rise over the next few years? Say 5 years have passed since the issuance of bond A. It's now 2018, at which time another corporation with a single A plus credit rating wishes to issue bonds maturing in 10 years in 2028, about the same date as the previously issued bond A. At the time the second bond, bond B, is being offered to investors, the market rate of interest for single A plus rated bonds maturing in 2028 is 6.5%. The issuer sets the coupon rate for bond B at 6.5%, permitting those bonds to be sold at par. But what would be an appropriate price for bond A, issued 5 years ago, which now carry a below-market coupon rate? We'll assume that bond A still has a single A plus credit rating, yet despite no deterioration of its credit rating, bond A will not be worth 100% of par. Why not? Because an investor could buy for 100% of par bond B, which has the same time to maturity and credit rating, but would pay the investor a better coupon. An investor holding bond A would not likely be able to sell that bond at par, given a coupon 1.5% below that of an equivalent risk bond trading at 100. The bondholder cannot alter the terms of the contract, such as coupon rate, principal amount, payment dates, etc. To sell the bond, the holder would have to be willing to drop the price enough to offset the impact of the below-market coupon rate to induce another investor to buy the bond. More specifically, the holder of bond A would have to offer to sell the bond at a price far enough below par such that the implied capital gain to maturity, along with the below-market coupon, would result in bond A having an expected rate of return to maturity comparable to that of bond B, purchasable at par with the higher coupon. Without delving into the specific mathematics right now, that means bond A's price would have to drop to approximately 89.095% of par. At that discount to par, there's an implied capital gain if held to maturity. If there's no default, the bond will be worth its par value at that time. That capital gain, along with the 5% coupon, offers an expected rate of return that's competitive to that of bond B being offered at par, carrying the 6.5% coupon rate. Naturally, the inverse relationship between a bond's price and its yield to maturity holds no matter the direction of rate change. So consider the impact of a decline in interest rates. Let's assume we have the same bond A from the previous example, the bond A that was issued in 2013, with a single A plus credit rating and a 5% coupon. That coupon equaled the market rate at issuance, so the bond was initially sold at par. And we'll again look ahead 5 years to 2018, though in this instance we'll assume a falling rate environment. In this scenario, say that there is a bond C with a single A plus credit rating about to be issued to mature in 10 years in 2028. But now let's say that the market rate of interest for 10-year single A plus rated bonds has fallen to 4.25%. The issuer of bond C sets the coupon rate at 4.25%, thus the bonds can be sold at par as the coupon rate equals the market rate of interest. Now a holder of bond A would be in a more fortunate situation compared to the rising rate scenario previously discussed. Now the 5% coupon on bond A is well in excess of the current market rate of interest. If a holder were to sell bond A at this time, it could be sold at a price above its par value since the bond is paying an above market coupon rate. Again, without delving into the specific calculation, at a 4.25% yield to maturity, bond A's price would rise to about 106.058% of par. Even though there would now be an implied capital loss if the bond were held to maturity, that price would represent fair value. Despite having to pay a premium to par, a rational investor would be willing to buy bond A. The implied capital loss, if held to maturity, would be compensated for by the above-market coupon that bond A carries. Similar to, but the reverse of what was said in the previous rising rate example, here the implied capital loss to maturity on bond A is counterbalanced by the above-market coupon, resulting in an expected rate of return over the 10 years to maturity approximately equal to that of bond C, with the 4.25% coupon currently being offered at par. Ultimately, most debt securities will be retired. Retirement can take place in a number of different fashions. The full principal of the bond might not be due until its stated maturity. That is the case with term bonds, which describes the maturity of all U.S. Treasury securities as well as most corporate bonds. Term bonds are also sometimes referred to as bullets, short for bullet maturity. There is a very different principal return profile for amortizing instruments. For amortizing securities, the principal is to be paid over time according to a specified amortization schedule. While the concept of maturity is the same as with term bonds, the date when the final principal payment is due, the import of maturity is quite different, as at least some, and in many instances the vast majority of principal has already been returned. Amortization schedules can take a variety of forms and often entail a balloon maturity, meaning a larger amount of principal is due at maturity than in the earlier periods. Aside from any scheduled amortization of principal, many fixed income securities have features that can result in principal return prior to the stated maturity. Early retirement can come in a number of forms: a call, a put, a sinking fund provision, or some other form of prepayment. The particulars of those early retirements vary. Let's investigate the most commonly encountered form of early retirement, that is, early retirement via a call. A callable bond is a bond that might be retired prior to its stated maturity. Most frequently, that would be at the issuer's option, though in some cases a call is mandatory, triggered by some event specified in the bond contract. Not all bonds are callable. For those issues that are callable, most are not callable immediately. There's usually some period of time before the first call date, referred to as call protection. Though it's less common, some callable bonds have no call protection. That is, they are immediately callable after issuance. Though I am not aware of any bonds having been called within a day or two of issuance, I know of a number of issues that have been called prior to the first coupon payment date. Unsurprisingly, the existence of an early retirement at the issuer's option generally benefits the issuer. The issuer is likely to call the bond when it's in the issuer's best interest to do so, which means it's probably not optimal from the bondholder's perspective. Consequently, most bonds that are callable at the issuer's option have to be called at a price above their par value. Optional calls usually require the issuer to compensate investors to offset the adverse impact of the early retirement. That additional amount is typically referred to as a call premium. Let's look at some examples of call provisions and call premiums. This diagram provides a visual that captures some common aspects of bond call provisions. We see a timeline running from issuance on the left to maturity on the right. The diagram reflects the most common circumstance with callable bonds, that most have some call protection. there is likely to be some period of time after issuance before the first call date. Oftentimes, that's as little as 2 to 3 years of call protection on a bond with a 10 or 20-year maturity, although the call protection can be significantly longer. The U.S. Treasury has not issued callable bonds since the late 1960s. Regular Treasury bonds have 30-year maturities. The last issue of callable bonds sold by the U.S. Treasury had 25 years of call protection. They were only callable during the last 5 years of the bond's life. While most callable bonds are callable continuously from the first call date all the way until their maturity, some bond contracts allow for calls only on certain specified dates between the first call date and the maturity. When a bond is callable, the bond contract, a legal document known as a trust indenture, would typically include a call schedule. The name might be somewhat misleading. Those not familiar with the terminology might reasonably understand it's the schedule according to which the bonds will be called or retired. Actually, call schedule is a reference to the schedule of call premiums that are payable, depending upon when during the bond's life the call is exercised. For example, assume there was a bond issued on 15 May 2014 to mature 20 years later on 15 May 2034. The bond first becomes callable on 15 May 2016, in other words, 2 years of call protection. On this page, there is an example of a call schedule. You'll note that the call premiums are expressed as a percent of par. Typically, as reflected in this example, the call premium declines the closer to the bond's maturity any call occurs. In fact, as is also indicated in this call schedule, and as is fairly common with callable issues, if the bond is called over the last few years prior to maturity, there might not be any call premium at all. To illustrate these matters, let's assume the bonds are called on the 15th of September 2020. In this call schedule, that would be in the 2020 to 2022 time frame, which indicates a 3% call premium. For a call on that date, an investor would receive 103% of par plus accrued interest. That is 100% of the par value plus a 3% call premium, as well as any interest earned from the last coupon payment date up until the call date, or 1,030 plus accrued interest per $1,000 par value of bonds. The final bit of information to consider regarding the bond under discussion is the price. Bond price quotes can be given as a dollar price, but are more often expressed as a percent of par value. The quoted price, or market price, is also sometimes referred to as the flat price or the clean price. Not all percent of par quotes can be interpreted the same way. Price increments can be expressed either in decimals or fractions of a percent. Most fixed income market segments have moved to a decimal form of price quotes, but for U.S. Treasury bonds and notes, as well as agency mortgage-backed securities, price increments are given in 30/2 of a percent. We'll look at some examples to illustrate the different styles of price quotes shortly. While we won't investigate it here in any detail, fixed income security values can also be quoted on a rate basis, or as it is sometimes said, on a yield basis. That means expressing the current market value on the basis of some interest rate, which for bonds would typically be their yield to maturity or yield to call as appropriate. The relationship between rate quotes and prices will be addressed in detail in several modules dealing with bond math. But let me be very clear. For a security quoted on a rate basis, the rate quote implies a specific price. A given security could be quoted either by a price or by an interest rate. The two alternative methods are different ways of expressing the same dollar value. While often confusing for newcomers to the fixed income business, quoting securities on a rate basis is quite common. Quoting on a rate basis provides a more direct way of comparing the cost of different securities in terms of what an investor is paying today per dollar of future cash flow. It should be noted that in most circumstances when a bond trade settles, the amount of money exchanged for the bond would consist not only of the agreed price, but also likely some portion of the next due coupon, an amount known as the accrued interest, which will be addressed in some detail later in this module. Let's look at some specific examples regarding these issues. By way of example, let's illustrate some of the concepts just discussed related to the way bond market participants express prices. The 95 in the hypothetical bond information implies a price of 95% of par value. Given par value of $100,000, multiply the $100,000 par value by 95%, 0.95 in decimal terms, gets to a market price of $95,000. As discussed earlier, 95 is what would be referred to as the market price, market value, flat price, or clean price. All of those phrases used interchangeably with one another. Also, as indicated earlier, by market convention, bonds are quoted flat. That is, bond values are quoted by clean or market price. But under normal circumstances, bonds are expected to trade with interest. That is, for a typical bond transaction, while the buyer and seller negotiate or agree a specific price, both parties will assume that the buyer will compensate the seller for the portion of the next due coupon that has been earned from the last coupon date up until the settlement date of the trade. That amount is referred to as the accrued interest. The seller is expecting to receive full value for sale of the bond, the market price plus accrued interest. The full value is oftentimes referred to as the dirty price. Let's take a closer look at price quotes. How are values expressed when prices should include a portion of another percent? How do we infer the value of the increments? We'll use a percent of par quote of 95.20 to illustrate market conventions. Assume the quote is given on a decimal basis, which is commonly how corporate and municipal bond values are expressed. Naturally, in decimal terms, 95.20 would mean 95.20% or 95.21%. So the decimal equivalent of the percent of par quote would be 0.9520. To determine the market price in dollars, multiply the $100,000 par value by the percent of par quote rendered in a decimal equivalent, 0.9520, to get a market price or flat price of $95,200. Other market sectors use different conventions for bond price quotes. So the same quote of 95.20 would imply a different percent of par amount and dollar price if the bond is quoted in 30 seconds, like Treasury bonds and notes or mortgage-backed securities. While the general process is the same, the conversion from the percent of par quote to the decimal equivalent generates a different value. For a bond quoted in 30 seconds, 95.20, which might also be expressed as 95:20 or 95-20, means 95 and 20/30 seconds percent. In this context, 95.20 rendered as a decimal equivalent would be 0.95625. Multiplying that times the $100,000 par value gets a dollar price of $95,625. To complete our introduction to bond price quote conventions, let's delve further into the different measures of bond values. We've already noted the difference between the quoted values and the amount exchanged between the buyer and seller at trade settlement, settlement referring to the completion of the transaction when the buyer and seller exchange the ownership of the bond for its full value in cash. Market convention: bonds are quoted flat but trade with interest. Layman's interpretation: bonds are normally quoted by market or clean price, but unless special circumstances negate it, the settlement amount will include an adjustment for the portion of the next due coupon earned until the change of beneficial ownership, an amount known as the accrued interest. Normally, both parties to the trade assume the buyer will pay the seller the bond's full value. That means not only the price at which they agreed to the trade, the quoted or market or flat price, but in addition to that, an adjustment for the portion of the next due coupon earned starting on the last coupon payment date and running up to but not including the settlement date of the trade. We'll look at a diagram to clarify that process on the next page. Two commonly encountered exceptions to the coupon accrual convention we've been discussing. 1. Zero coupon bonds. Such bonds have no coupon, so there is no coupon to accrue. 2. Bonds in default. If the issuer hasn't been paying interest in the past, why should we make an adjustment for a coupon payment that, at least based on recent history, is unlikely to be paid? Zero coupon bonds and bonds in default are quoted flat and trade flat. Let's take a closer look at accrued interest. To recap, at settlement, the buyer owes the seller the bond's full value, the agreed market price plus accrued interest, the sum of which is oftentimes referred to as the dirty price. The accrued interest represents the portion of the next due coupon that's owed to the seller for interest that was earned starting on the last coupon payment date and running up to but not including the settlement date of the trade. This diagram tries to capture those ideas and was drawn consistent with the way the words were just spoken. You'll note that the seller starts earning interest as of the last coupon payment date and earns interest for the time up to but not including the settlement date of the trade. In other words, on the day a coupon becomes payable, that coupon is for interest earned up to but not including the coupon payment date. For example, assume a bond has coupon payment dates of January and July 15th. When the July coupon becomes payable on the 15th of July, it is for interest earned through the 14th of July, the day prior to the coupon payment date. On the date a coupon becomes payable, the next due coupon has already started to accrue interest. That is why the day count for accrued interest begins on the last coupon payment date. Example using a bond with the same coupon payment dates. On the 15th of July, the day the July coupon becomes payable, next January's coupon has already started to accrue interest. Now we turn to the investment characteristics of fixed income securities. Specifically, let's look at the sources of return and types of risk confronting investors in fixed income instruments. By sources of return, I'm not trying to reference something theoretical, such as investors earn a return for letting issuers have the temporary use of their investment capital, or investors are compensated for bearing credit risk. Rather, what are the factors that contribute to measured return on investment? What determines the numbers that will be used in calculating portfolio return over some reporting period? In general, sources of return can be divided into three broad categories: cash flows, reinvestment income, and price changes. Cash flows would consist of monies received from investment holdings during the period for which return is being measured. Of course, when considering a single term bond, the only cash flows received prior to maturity would be the periodic coupons. However, it's probably best to think about returns to fixed income investment consistent with the way securities are held. The vast majority of bonds are held by institutional investors as parts of large diversified portfolios. Consequently, for any reporting period, cash flows would be comprised not only of the coupons received, but also likely include some principal. For the typical portfolio during the quarterly or annual reporting period, almost certainly some bonds will either have matured or been called, or there could be some amortizing securities in the portfolio, which return principal over time. Cash flows received will be reinvested almost immediately, perhaps into a liquidity instrument initially, something short-term, even overnight, until another longer-term investment opportunity is identified. Reinvestment income, also called compound interest or interest on interest income, will have a significant impact on return over time. In the short run, price changes resulting from movements in interest rates will likely have the biggest impact on bond portfolio returns. Price changes include not only realized gains or losses on securities sold, but also price changes on securities still held in the portfolio. Most trading and asset management companies use mark-to-market accounting, meaning unrealized gains or losses on securities still held will be reflected in reported returns. We previously touched on how bond prices move inversely to changes in interest rates. Let's consider the interest rate change a little bit more closely. For most bonds, we can disaggregate the interest rate change impacting price into several components. Securities will often be priced relative to some benchmark. In the U.S., most fixed income market sectors price off of the U.S. Treasury yield curve. Most European Union countries use the euro, so there is not a government bond market for Eurozone country debt issues to price off of. Consequently, euro-denominated bonds price off of the LIBOR swap curve. But it's changes in those base interest rates or benchmarks that are likely to filter throughout the credit markets. While changes in U.S. Treasury rates will typically ripple across all U.S. market sectors, the different sectors do not move in perfect lockstep. The amount by which interest rates differ between two market sectors, for example, U.S. Treasuries and AAA-rated corporate bonds, is not constant. In the parlance of the markets, sector spreads can change as markets assess the relative risk and value in the different market sectors. Another factor to consider is the impact of any embedded optionality. Recall the earlier discussion of callable bonds. The presence or absence of an embedded option for early retirement can cause a dramatic difference in the way bond prices respond to changing interest rates. The prices of callable bonds versus the prices of non-callable bonds respond very differently as market rates fall towards or through the coupon rate on the bonds. A detailed discussion of the impact of embedded optionality is beyond the scope of this introduction. Positive and negative convexity, the formal terminology for describing the different price behavior of callable versus non-callable bonds, is addressed in other modules. Any balanced discussion of investment characteristics would consider not only the expected returns but also the risks, the factors that cause future returns to be uncertain. All investments expose their holders to risk. Though many fixed income investments are viewed as safer than most other types of financial instruments, nonetheless, holders of even highly rated debt securities face a variety of risks. Investors in high yield debt face risk to an even greater degree. Before looking into the different types of risk individually, it might be helpful to put the discussion of risk into a broader context first. What is an insightful way to think about risk? All too often, people that have not previously been exposed to the perspective I'm about to recommend associate risk with something bad or negative. That's not a helpful way to think about risk. It's impossible to avoid all risks. There are no investments that avoid all risks. Even if an individual decides to try to avoid risk by not investing, simply keeping all of their wealth in cash, they would still be exposed to inflation risk. As it's impossible to avoid all risk, it becomes a matter of picking and choosing among the risks to which one wants to be exposed. Presumably, knowledgeable portfolio managers take the risks they believe will work out in their favor and try to avoid or minimize the risks they either don't understand or believe will play out to their disadvantage. So think of risk as uncertainty. It's true, low-risk investments probably only expose investors to a small loss no matter how adverse market conditions get. But low-risk investments probably offer at best a small gain no matter how good the market environment. In other words, a low-risk investment is an investment with a very narrow range of likely future outcomes. Small upside no matter how good, small downside no matter how bad. Think of a short-term U.S. Treasury bill, for example. On the other hand, a high-risk investment is one where there is a wide range of possible future outcomes. Big downside if things turn out really poorly, but huge upside if things turn out really well. A CCC rated junk bond, for instance. However, even with a high-risk investment, most of the outcomes will likely be towards the middle of the range of the distribution of possible returns. It's just that with high-risk investments, there is a lot more tail risk, much greater potential for extremely large positive or large negative returns. Let's now consider the different dimensions of risk one at a time. The focus will be on common types of risk investors encounter with most fixed income instruments. For most fixed income investors, default or credit risk is a primary consideration. The phrases default risk and credit risk are completely interchangeable. They refer to an assessment of the issuer's ability to pay principal and interest in full in a timely fashion. As indicated earlier, credit risk is usually a function of the issuer's financial strength, although that can be modified by various forms of credit enhancement such as pledging assets as collateral or buying insurance. Credit risk is the type of risk that's quantified by the credit rating agencies, Moody's and Standard & Poor's being the most prominent. Aside from the issuer's creditworthiness or any credit enhancements, time to maturity is also a consideration. Naturally, the longer the time to maturity, the greater the uncertainty because of a longer period of time for something to go amiss. The credit rating system of Standard & Poor's provides a widely accepted framework for establishing standard definitions of investment grade versus high yield. The rating scale covers a continuum of creditworthiness running from AAA for the highest credit quality securities to lesser and lesser quality securities as we go down the scale, all the way down to single D for bonds currently in default. Bonds rated BBB and higher are considered investment grade. BB and below are considered less than investment grade, also called high yield securities or junk bonds. High credit quality means that there is very little doubt about the issuer's ability to pay interest and principal in full as it comes due. Securities having an upper investment grade credit rating, such as AAA or AA, would be considered of the highest credit quality. Where there are significant concerns, or at least a lack of clarity about an issuer's ability to pay interest and principal as it comes due, the issues are likely to be perceived as having lower credit quality. High-yield securities or junk bonds would be considered as having low credit quality. For most debt securities, it's the issuer's sole responsibility to service the debt. That is, pay interest and principal as the payments come due. Making those payments requires cash, so the issuer's ability to generate cash flows will be about the most important factor in assessing credit risk for the vast majority of fixed income securities. For most issuers, it's the ability to generate revenues in the normal course of their operations that will be the primary consideration when assessing creditworthiness. For corporations, that would likely be sales revenues. For governments, typically tax revenues. Other possible sources of cash flow can be considered if appropriate. If the issuer has a substantial amount of valuable assets, asset sales is a possible source of funds to service debt. Also, if the issuer is not already carrying an excessive debt load, the proceeds of future bond issues can be used to refund maturing or called debt. There are other factors that might come into play when assessing creditworthiness. A specific issue of securities can qualify for a higher credit rating if the debt contract provides the investors with additional protection beyond the issuer's promise to pay coupons and principal. The issuer might have valuable assets that could be pledged as collateral. In the case of such secured bonds, as they are called, were the issuer to violate the terms of the contract, the bondholders could take possession of the pledged assets. In some cases, bond issuers or investors can go to a third party to obtain bond insurance or some form of guarantee. These forms of credit enhancement mean that were the issuer to fail to make payment of interest or principal, the provider of the insurance or guarantee would be obligated to make payment on the issuer's behalf. Such issues' credit ratings will be based on the creditworthiness of the provider of the enhancement rather than the issuer. Pledging assets as collateral or obtaining some form of credit enhancement can result in an issue of securities getting a higher credit rating than the issuer's general credit rating. Given the impact on bond prices of changing interest rates, it's obvious interest rate related risks are of major concern to investors in most fixed income securities. However, changing interest rates have consequences well beyond the immediate impact on price. If you recall the earlier discussion about sources of return, you can imagine how changing interest rates would impact the rates at which we can reinvest future cash flows. And there is even a potential impact on the timing of principal payments when the issuer or borrower has the ability to call or prepay the debt. While a discussion of call or prepayment risk is beyond the scope of this module, let's investigate the first two interest rate related risks cited above: price risk and reinvestment risk. And let's cover them in that order. Let's start with price risk. We've already looked at the impact on bond prices of changing interest rates. Though I prefer to call it price risk for sake of clarity, most authors or speakers use the phrase interest rate risk when referring to the impact on bond prices of interest rate changes. Whether calling it price risk or interest rate risk, some even say market risk, these are ways of assessing the sensitivity of a bond's price to changes in its yield to maturity. Duration, or DV of an 01, or stated more formally, the dollar value of a basis point, are two common methods for trying to quantify this risk. As the impact of any change in interest rates is compounded over the time until receipt of the cash flow, price risk is directly related to maturity. Other things equal, the longer the time to maturity, the more sensitive a bond's price will be to changes in interest rates. For an individual bond, duration quantifies how sensitive the bond's price is to changes in a specific interest rate, the interest rate that expresses the current value of the security, the bond's yield to maturity. Duration quantifies the impact of a yield change, whether due to changes in the price of credit generally, in other words, shifts in the Treasury yield curve, and or changes in the market's perception of sector or issuer-specific credit risk, change in credit spreads. Reinvestment risk relates to the uncertainty about the interest rates at which investors will be able to reinvest future cash flows. In a portfolio context, that would relate to all future cash flows, not only interest income, but also any principal received, whether due to bonds maturing, being called, or periodic return of principal on amortizing securities. When spoken of in the context of an individual bond, reinvestment risk normally refers to the uncertainty related to the reinvestment of cash flows received prior to maturity. For non-amortizing securities, since there is no return of principal prior to maturity, over the life of the issue, reinvestment risk is directly related to the coupon. The higher the coupon rate, the more money that will have to be reinvested at unknown future interest rates, therefore the greater the reinvestment risk. At the opposite end of the reinvestment risk spectrum, zero coupon bonds have no reinvestment risk over the life of the security because no money is received prior to maturity. Think about the interplay between coupon rates and changing market interest rates regarding the impact on reinvestment income. Compare securities with the same maturity and credit risk but different coupon rates. Say two Treasury securities maturing in 10 years, one a 30-year bond issued 20 years ago having a 7% coupon, interest rates were significantly higher 20 years ago, the other being a 10-year Treasury strip, a type of zero coupon security. Which security would you rather own in a rising interest rate environment? The high coupon bond or the zero coupon security? For otherwise equivalent securities, an investor would clearly be better off with a higher coupon bond. The holder of the bond will receive a portion of the return in periodic coupons and be able to reinvest at those higher rates, getting some benefit from them. Conversely, if rates fall, other things equal, an investor would prefer to have a smaller portion of the total return tied to reinvestment income at lower market rates. Zero coupon bonds eliminate reinvestment risk over the life of the security. So in a rising interest rate environment, more reinvestment risk would be a desirable investment characteristic for a security or a portfolio. Do all investments really expose investors to risk? If an investor buys a 3-month U.S. Treasury bill and holds to maturity, is there any risk exposure? The likelihood of a U.S. default over the next 3 months is effectively zero. There's no price risk if a security is held to maturity and there's no default. There are no cash flows received prior to maturity, so there's no reinvestment risk over the life of the investment. So where's the risk? Well, since it's impossible to precisely forecast inflation rates, the investor still faces some purchasing power risk. It's not the dollar amount, but rather the purchasing power of their wealth that should most concern investors. Given the economy has recently been experiencing a stable inflation rate environment, any inflation forecast error over such a short time period is likely to be minor. That's why a short-term T-bill is a low-risk investment as opposed to a no-risk investment. Purchasing power risk addresses the impact on money returns of changes in the general level of prices. Purchasing power risk refers to the uncertainty about what you'll be able to buy with the money once it's received. Even when an issuer pays all interest and principal in full in a timely fashion, one cannot be sure of the purchasing power of those monies. Prices of goods and services change over time. Over the last century, prices have generally risen, although at variable and unpredictable rates. Ergo, the uncertainty about the purchasing power of future cash flows. An increase in average prices is defined as inflation, which means money received in the future will have less purchasing power than money spent today. High or rising inflation rates are anathema to bondholders because of the reduction of the purchasing power of cash received in the future. Given the experience of recent generations, one might wonder why not simply call it inflation risk. That's because, though not common in the modern era, outside of Japan anyway, there can always be negative inflation, which is more commonly referred to as deflation. While economists fret about it, from a bondholder's perspective, unanticipated deflation is an ideal circumstance. Deflation means falling prices, which causes any money the bondholder receives in the future to have more purchasing power than money in hand today. Liquidity was touched on earlier. Liquidity risk relates to the uncertainty about the ease or difficulty of turning an investment into cash. An assessment of liquidity entails consideration of several elements. It's not simply a matter of being able to turn an investment into cash. Usually, for an investment to be considered liquid, there are timing and value considerations. With a liquid investment, an investor would expect to be able to turn their securities into cash relatively quickly and at a price that is reasonably consistent with a security's fair value. So 3 elements have to be present for an investment to be considered liquid: being able to turn the investment into cash on short notice and get a price that's consistent with current fair value. We can get some insight into a security's liquidity by the size of the bid-ask spread. The more liquid a security, the narrower the spread is likely to be. And one can also get some sense of liquidity from trading volume. Unsurprisingly, a greater trading volume would imply more liquidity or less liquidity risk. Of course, not all investments are liquid. The less liquid a security is, the greater the liquidity risk. And other things equal, the security would likely trade at a higher yield. Market participants would view a wide bid-ask spread or low trading volume as indicators of less liquidity and consequently more liquidity risk. Let's try to integrate a number of the ideas addressed over the course of this module by connecting the different types of risk just discussed with the various features of bond contracts covered earlier in the session. When assessing the investment characteristics of individual securities, an investor would want to determine their exposure to the different types of risk, which is strongly related to the terms of the bond contract. A fuller appreciation of investment characteristics can be gained through understanding the connection between the specific contract features and the individual dimensions of risk. In this module, primary impacts will be indicated by a solid line between the type of risk and the related contract feature, secondary impacts by dashed lines. Credit risk. Absent any credit enhancements, the primary determinant is the issuer's financial circumstances, ability to generate revenue, value of assets, etc., and the time to maturity. The longer the time to maturity, other things equal, the greater the perception of credit risk because there is more time for something to go wrong. Liquidity risk. Primarily a function of the bond's creditworthiness, which ties to the issuer's financial circumstances, as well as the time to maturity. In general, other things equal, the shorter the time to maturity or the higher the credit rating, the more liquid the security or the lower the liquidity risk. The longer the time to maturity or the lower the credit rating, the less liquid the security or the greater the liquidity risk. Purchasing power risk. The longer the time until the receipt of the monies, the greater the uncertainty about the potential change in price levels before the money is received. Interest rate related risks. Well, there's two: price risk and reinvestment risk. Price risk. The sensitivity of a bond's price to a change in interest rates is directly related to the time until the receipt of the cash flow. Other things equal, the longer the time to maturity, the greater the price risk, the shorter the time to maturity, the less the price risk. While most impacted by maturity, the coupon is a secondary impact that works counter to the impact of maturity. The higher the coupon, the less sensitive a bond's price to a change in rates, as a larger portion of the total cash flows is received sooner. Reinvestment risk. The uncertainty about the interest rate at which future cash flows can be reinvested. For an individual security, reinvestment risk is directly related to the proportion of the cash flows received prior to maturity, which for term bonds is the coupon. Other things equal, the higher the coupon, the greater the reinvestment risk. Zero coupon bonds have no reinvestment risk over the life of the bond because no cash flows are payable prior to maturity.